Trading fair value gaps is not simply about finding an imbalance on the chart and placing a limit order inside the zone. What truly determines whether a setup succeeds or fails is the context behind the formation. Without liquidity, market structure, directional bias, and higher time frame alignment, even a perfectly clean fair value gap can become a weak and low probability setup. Welcome to the Calm Lucro channel. In this video, you are going to learn how fair value gaps are combined with multi-timeframe analysis, liquidity sweeps, and market structure shifts to build high probability trading setups with greater precision. By the end of this session, you will understand how to identify stronger fair value gaps, align higher timeframe direction with lower timeframe execution, and use fair value gaps as structured entry zones instead of treating them like random support and resistance levels. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let's begin with the trading framework itself. This strategy is built around fair value gaps, higher time frame structure, and lower time frame execution. Instead of trading fair value gaps blindly, we use them as reaction zones inside the broader market context. The goal is to align directional bias, liquidity, and timing before entering the trade. This framework is divided into two major stages. First, we analyze the higher time frame to determine market direction, identify liquidity areas and key levels, and locate high-quality fair value gaps that can serve as optimal trading zones. In the second stage, we move down into the lower time frame to look for confirmations and execute the trade with more precision. This strategy can be applied to different markets and chart combinations. However, your execution time frame should generally be at least 2 levels lower than the higher time frame used for analysis. Here are 3 common time frame combinations you can adapt depending on your trading style and execution model. For example, if your higher time frame is the 4-hour chart, the 15-minute chart can be used for execution and confirmation. As mentioned earlier, we simplify this framework into 2 major stages. So let's begin with the first one, analyzing market structure on the higher time frame. During this phase of the analysis, we apply smart money concepts to identify market direction, structural behavior, and important reaction levels. To determine directional bias, we focus on breakouts, reversals, and liquidity sweep formations. So, let's manually identify the break of structure, CHoCH, and liquidity sweep formations directly on the chart. At this stage, we can clearly see multiple bullish breaks of structure forming, confirming that the overall market direction remains bullish. Later, price sweeps liquidity above the previous high, signaling that a potential reversal or a deeper pullback may start to develop. This potential reversal becomes confirmed once price breaks and closes below this low, forming what is known as a change of character. This occurs when the market fails to create a new higher high and instead breaks below the previous swing low. That behavior suggests buyers are losing control, while sellers begin taking over the market structure. A bullish liquidity sweep occurs when price briefly moves below a key area, triggers stop losses resting under the lows, and then quickly closes back above the range. When this type of liquidity sweep occurs, we usually anticipate price pushing higher afterward. On the other hand, a bearish liquidity sweep forms when price trades above a major swing point, takes the liquidity resting above the highs, and then quickly returns back below the range. When this happens, we typically expect bearish continuation toward lower levels. When marking these sweeps manually, bullish and bearish liquidity sweeps can be identified by observing these sharp rejections around major swing highs and lows directly on the chart. Many traders also choose to highlight these areas using green and red circles to make the liquidity reactions easier to visualize during analysis. Now, keep this in mind. If you are unable to clearly read the market structure or determine the overall direction on your selected higher time frame, it is usually better to avoid forcing a trade and move to another asset instead. Unclear structure often leads to emotional decisions and inconsistent execution. Focusing only on markets with cleaner directional behavior helps improve discipline and keeps your trading process more structured. The final step in the higher time frame analysis is identifying strong fair value gaps that can act as high probability reaction zones. So let's manually identify the fair value gaps directly on the chart. By focusing on the larger and cleaner imbalances, smaller and weaker fair value gaps are naturally filtered out, allowing us to concentrate on the most meaningful areas of inefficiency. Once the optimal trading zone has been identified, we simply wait for price to return into that area, before shifting down to a lower time frame to search for confirmation and execution opportunities. This is the overall foundation behind the trading framework. Now, let's move into the second phase of the strategy, which focuses on lower time frame confirmation and trade execution. After price enters our higher time frame trading zone, we want to see evidence that the short-term bullish momentum is weakening and that price may be preparing to rotate lower. To identify that transition, we focus mainly on liquidity sweep behavior and changes in market structure. A valid liquidity sweep above the previous high can act as an early warning sign that a reversal is beginning to form. Aggressive traders may choose to enter the short position immediately after the sweep occurs. In this situation, the stop loss can be placed above the high of the liquidity sweep candle, while targeting the next important levels ahead of price. More conservative traders may prefer waiting for price to break and close below the recent swing low to confirm the change of character before entering the trade. Once the reversal confirmation is in place, we then wait for new fair value gaps to form on the lower time frame. This is why the framework is often referred to as higher time frame and lower time frame fair value gap alignment. However, this does not mean the lower time frame fair value gap needs to form directly inside the higher time frame gap. The important idea is that the higher time frame fair value gap defines the main reaction zone, while the lower time frame fair value gap provides the precision entry after confirmation appears. After identifying a valid lower time frame fair value gap, we can place our sell limit at the beginning of the zone and position the stop loss above it. For trade management, one common approach is to secure partial profits and move the trade to break even once price reaches the 1-to-1 target. The next target can then be projected toward the nearest important higher time frame level, positioned ahead of price. Now, before we move into real chart examples, there are some common situations that traders need to understand when dealing with fair value gaps. In the first scenario, the fair value gap is extremely small. When this happens, using the gap itself as the stop placement may expose the trade to normal market noise and random fluctuations. In situations like this, using a slightly larger structural area for the stop loss can help protect the trade more effectively. In the opposite situation, we may have an unusually large fair value gap on the lower time frame. The problem here is that placing the stop loss below the entire zone may create excessive risk and reduce the quality of the risk-to-reward ratio. In this type of setup, we can either reduce the stop placement using a smaller structural area below the fair value gap, or position the buy order closer to the midpoint of the imbalance. By doing this, the potential risk-to-reward profile improves significantly whenever the trade develops successfully. Now, let's move into some real chart examples. On the Euro-USD 1-hour chart, the market was previously in a clear bearish trend before forming a liquidity sweep followed by a change of character. Together, these signals suggest that sellers are beginning to lose control and that the overall directional bias may now be shifting bullish. On this chart, we can identify two different fair value gaps, but according to our framework, only the gap positioned on the discount side of the range qualifies as a valid trading zone. After marking that area, we simply wait for price to retrace back into the fair value gap before moving into the lower time frame to search for bullish execution opportunities. When we shift down into the 5-minute chart, we can see that price forms a change of character by breaking above this level, which acts as our confirmation that momentum is beginning to shift. At this stage, we identify a new fair value gap on the 5-minute time frame and use that area as our execution zone. We place our buy order at the beginning of the imbalance, position the stop loss below the zone, and target the next important higher time frame level positioned ahead of price. Now, let's see how this setup develops. In the next example, we move to the CAD JPY 1-hour chart, where the market is trading inside a clear bearish trend with multiple fair value gaps visible on the chart. However, after applying the retracement tool and analyzing the range correctly, we can see that only one of these fair value gaps qualifies as a valid premium supply zone according to the rules of our framework. Once this trading zone is identified, we wait patiently for price to retrace back into the area before moving into the lower time frame to search for execution opportunities. When we zoom into the 5-minute chart, price forms a change of character together with a new fair value gap, creating the confirmation needed for the entry setup. At this point, we place our sell limit at the beginning of the fair value gap and position the stop loss above the zone. As we can see, this trade eventually develops into a successful setup. However, it is important to understand that losses are a natural part of trading and cannot be completely avoided. No matter how effective a strategy may appear, losing trades will always exist. A losing position does not automatically mean your analysis was incorrect. What matters most is having a clear set of rules, following them consistently, and applying disciplined risk management throughout the process. As long as you maintain consistency and protect your capital properly, the probabilities can work in your favor over time. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the CoMluCro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the CoMluCro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.